Hi everybody, Michael Goff here again. In this part of Chapter 3, we're going to focus on the actual adjusting entries. Then we're going to move to the next step in the accounting cycle, that is the adjusted trial balance. What happens once those entries have been entered into the accounting system and we're able to put those forward so we can summarize the effects on all of the accounts? That's what we're going to do here. So follow along. So our next objective here is to journalize entries for accounts requiring adjustment. So you might remember our unadjusted trial balance for Net Solutions. And again, remember this comes after we've journalized and posted and then taken the ending balance from all the ledger accounts before we've done the adjusting entries. So Net Solutions Supplies on Account has a balance of $2,000 on the unadjusted trial balance. Some of these supplies have been used. An account reveals the amount of supplies on hand is $760. So what that means is that we actually used up $1,240. If I had $2,000 worth of supplies, I have $760 remaining. That means $1,240 was used up. So as a result of that, our entry is going to be debit supply expense $1,240 and credit supplies $1,240. So the idea is we recognize an expense that will cause net income to go down and our asset goes down at the same time. Now, then, the debit balance of $2,400 in the prepaid insurance represents a December 1st prepayment of insurance for 12 months. So we take a look at this and we say, okay, if I take $2,400 divided by 12 months, that's $200 a month. So as a result of that, I'm going to recognize $200 in insurance expense and credit prepaid insurance. So debit insurance expense $200, credit prepaid insurance for the same amount. Now, if I don't do this, what's going to happen is that I'm going to understate my expenses. And if I understate my expenses, I'm going to overstate my net income. And then my assets will be overstated as well. So as a result of that, if we don't do our adjusting entries, we'll find that we can't rely on our financial statements. And this is one of the reasons that when certified public accountants audit the books of public companies, they want to look at the adjusting entries very closely because, in fact, if we're not careful or if we're less than honest, that's a good place to hide income, as it were. Okay, prepaid insurance in this example had a beginning balance of $6,400 and was debited for $3,600 of premiums during the year. Journalize the entry at the end of the year given that the unexpired insurance is $3,250. So we take a look at this and we say, okay, $6,400 plus the $3,600, that's a total of $10,000. Minus the $3,250 that remains, that means we debit insurance expense $6,750 and credit prepaid insurance $6,750. So it's very common for companies to have several insurance policies and to pay them ahead and then to recognize the expense at the end of a quarter or the end of the year, something along those lines. Okay. The credit balance of $360 of Net Solutions unearned rent account represents the receipt of 3 months' rent on December 1st for December, January, and February. So we've earned 1 month's worth of rent here. So we're going to debit unearned rent $120 and credit rent revenue for the same amount. That's $360 divided by 3. So in this example, what we see is that our liabilities are going down and our revenues have gone up. So if we don't recognize this, we're going to understate our revenues, and as a result, we'll understate our net income as well, and our balance sheet will overstate our liabilities. So the idea is adjusting entries tend to always affect the income statement and the balance sheet. That's one of the definitions of an adjusting entry. So in this example, we say the balance in the unearned rent account before adjustment was $44,900. Journalize the adjusting entry if the unearned fees at the end of the year is $22,300. So we say $44,900 minus $22,300 means we debit unearned fees of $22,600 and credit fees earned $22,600. Now we see Net Solutions signed an agreement with Danker on December 15th to provide services at $20 an hour. As of December 31st, they've provided 25 hours of services, and the revenue will be billed on January 15th. So what's going to happen is we're going to take 25 times 20. That means they owe us $500. So we're going to debit $500 to accounts receivable, credit fees earned for the same amount. So the idea here is that we have an increase to our assets and an increase in revenue. And if there's a misstatement there, we would have understated our revenues, understated our net income. We would have understated our assets as well. And here we have at the end of the year, $13,680 of fees have been earned but not billed to clients. So we're going to journalize that. So we're simply going to debit accounts receivable $13,680 and credit fees earned for the same amount. Now, one of the things that we find is that years typically don't end on Fridays, do they? As a result of that, in December, in this example, we see that the year ends on December 31st. So that means whatever wages that are owed for 30th and 31st belong in December expenses, and whatever is earned for the 1st, 2nd, and 3rd belong in the January expense. The problem is if you're a company that pays its salary once a week on Friday, you have to make sure that you split that. You have to do an adjusting entry. So Net Solutions pays its employees biweekly. During December, Net Solutions paid wages of $950 on December 13th and $1,200 on December 27th. As of December 31st, they owe $250 of wages for Monday and Tuesday of December 30th and 31st. So there we're going to debit wage expense $250, credit wages payable for the same amount. So the idea is that this is money that has to be recognized for December, not for January. The idea is we don't want to understate our expenses for December because that would be a problem. Now, Net Solutions pays wages of $1,275 on January 10th, and that includes that $250 of accrued wages. So what we're going to do is a compound entry for that transaction. We debit wage expense $1,025, that's for January, and then we debit wages payable, those were for December, in the amount of $250, and credit cash for $1,275. That's how we clean things up. And again, had we not put this entry in, we would have understated our expenses and therefore overstated our net income. So the idea is that, again, we would have had an effect on both the income statement and the balance sheet. Fixed assets or plant assets are physical resources owned, used by a business, and are permanent or have a long life. And as time passes, they begin to lose their value, and we call this depreciation. Now, all fixed assets, except for land, and that's important, you never depreciate land, lose their usefulness, and so we depreciate them. And as fixed assets depreciate, we recognize this depreciation expense. Now, we have a special account called accumulated depreciation. Rather than buy a truck for $20,000 and basically reduce the truck from $20,000 to $19,000, what we do is we have a special account called a contra account, accumulated depreciation, that stays with the truck account. So as a result of that, this accumulated depreciation account is an account we're going to become very familiar with. And we think this to be important for our investors and managers. So the idea is land doesn't have a contra asset account, but we'll find that buildings has accumulated depreciation associated with buildings, store equipment, accumulated depreciation, store equipment, office equipment, the same thing. So Net Solution estimates the depreciation on its office equipment to be $50 for the month of December. So we go ahead, debit depreciation expense $50, credit accumulated depreciation office equipment $50. So the idea is you'll notice that we have office equipment of $1,800. That doesn't change, but our accumulated depreciation for the office equipment does. And then, of course, we recognize the $50 depreciation expense. Now, the difference between the original cost of the office equipment and the balance in the accumulated depreciation is called the book value. Okay? And it's computed just like this. We take the book value of an asset, and that's equal to the cost of the asset minus the accumulated depreciation of the asset. Okay? So for the office equipment, the cost of the office equipment minus the accumulated depreciation of the office equipment. So the office equipment is now sitting at $1,750. Cost was $1,800. We've taken a total of $50 depreciation expense, so the book value is $1,750. At the end of next year, it will be $1,700. That is, $50 depreciation will be recognized. Or if we're depreciating on a monthly basis, $1,700 at the end of next month. Now, if we don't do our depreciation, we're going to understate our expenses, overstate our net income, and we're going to overstate our assets. Now, let's summarize the adjustment process. So the idea is that supplies and prepaid insurance, those get adjusted so we can update them. So typically we debit the expense and credit the asset. Okay, so we had supply expense and insurance expense, and that affects both the income statement and the balance sheet. Then we have unearned revenues. That's a liability, and so there typically we debit unearned rent, credit rent revenue, or debit unearned fees and credit earned fees. So the idea is this affects both the income statement and the balance sheet from a profitability and from an asset and liability perspective. Then there are accrued revenues. This is where we've performed work, we're owed the money, we have to recognize the revenue. Debit accounts receivable, credit fees earned. And then accrued expenses, where we've incurred expenses that have to be paid, but we want to associate them with the current period. So there we would debit wage expense and credit wages payable in that regard. Depreciation, this is where we recognize the depreciation expense on a regular basis for our assets. So there we debit depreciation expense and credit accumulated depreciation, that contra asset account. So these adjusting entries that were done for Net Solutions, debit supply expense, credit supplies, debit insurance expense, credit prepaid insurance, debit unearned rent, credit rent revenue, debit accounts receivable, credit fees earned, debit wage expense, credit wages payable, and debit depreciation expense, credit accumulated depreciation, office equipment. And so the idea is then we're able to update our ledger accounts because this all has to get posted, doesn't it? And so ultimately the ledger gets fully adjusted, okay? And then what happens is you take those adjustments and you say, okay, now I'm ready for an adjusted trial balance because the trial balance has changed, hasn't it? So as a result of that, what we're trying to do is we want to make sure that our debits and credits are equal, that we've recorded everything properly. So as a result of that, now we have the adjusted trial balance. You'll notice that cash is the same, but accounts receivable has changed, supplies have changed, prepaid insurance has changed, wages payable, unearned rent, and so forth. So the idea is several of the accounts have changed in the adjusted trial balance. Okay, now, then we can use vertical analysis to evaluate a company's financial condition using these amounts. Okay, now, what's going to happen is after we have the adjusted trial balance, then we can put together an updated income statement, statement of owner's equity, and balance sheet. And we put that together as quickly as possible so managers and investors will have that data as early as possible so they can make good decisions. Now, when we compare each item in a financial statement with the total amount from the same statement, it's referred to as vertical analysis. So here we have an example again of J. Holmes, attorney at law, and what we see is we see that utility expenses changed by about $3,500. That is from $9,000 to $12,500. We see that fees earned have gone up and so forth. So the idea is that we take a look at our percentage change year over year, and then our percentage change in terms of total revenue. So for instance, in 2011, utilities represented 6% of revenues, whereas in 2012 it represents 6.7% of revenues. This is good information because it tells us, are we running the business well? Do we need to make some changes or something along those lines? Here we see an example where supply expense have gone from $3,000 to $2,700, and as a percent, it's gone from 2% to 1.4%. So the idea is that we're in a better space in terms of using our supplies. Okay, so let's do vertical analysis here for Forst & Company, or Forts & Company rather, where we're going to take a look and see how we're doing. So the idea is that 56% of our revenues were operating expense in 2011, but 62% are what we're seeing in 2012. So obviously our operating expenses have gone up. Now, the good news is that our revenues have gone up, but the bad news is our profitability has not. So that tells us our operating expenses are running high. So this allows us to ask the question, why did this happen? What is the purpose in that regard? Now, we finish up Chapter 3. So the question is you need to ask yourself at this point is, can you prepare a trial balance properly, an unadjusted trial balance? So can you journalize, post to the ledger, and do a trial balance? That's number one. Then, do you know the difference between a trial balance, a balance sheet, and an income statement? And then, can you do adjusting entries in proper form and adjust them accordingly? And then, can you do an adjusted trial balance? And do you understand that? And can you explain that to someone else? If you can, then you're ready for Chapter 4. If you can't, then you need to go back to Chapter 3 and go through those adjusting entries and make sure you understand all those concepts in that regard. So as is always the case, I encourage you to stay with it, take a lot of notes, take your time, and you'll probably be just fine. Until next time, I wish you well.